Hey everyone, welcome back to Corporate Decoder, the place where we unravel the mysteries of the financial world. But this time, it is like trying to find a ripe cantaloupe in a whole field of them. A sweet surprise it seems, or is it? Get ready for a deep dive into Cantaloupe Incorporated's latest financial report. We're going to slice through the numbers and see if this company's growth story is truly ripe for the picking, or if there is a rotten core hidden beneath the surface. Let us start with a look at Cantaloupe's financial health right now. As of the 31st of December 2025, their total assets stand at a hefty $381.9 million. That is a pretty substantial number, showing they have a lot of resources at their disposal. Looking closer at what they own, their current assets, which are things they can turn into cash fairly quickly, like cash itself and inventory, amount to over $159 million. That is a healthy chunk, meaning they can cover their short-term obligations. Now, a big number that often catches the eye is goodwill. Cantaloupe has over $103 million in goodwill. Think of goodwill as the premium they paid for acquisitions beyond the fair value of the actual assets. It represents brand value, customer loyalty, and potential future earnings from those acquired companies. On the other side of the coin, we have their liabilities, what they owe. The total liabilities are around $126.7 million. This means they owe more than they have in current assets, but when you look at total assets, their overall financial position seems stable. Digging into shareholders' equity, we see their additional paid-in capital is a massive $488.9 million. This is basically the money investors have paid for stock above its par value, showing a strong history of investor confidence. However, there is an accumulated deficit of nearly $237 million. This means that over time, the company has spent more than it has earned. This is not uncommon for growing companies, but it is something to keep an eye on. Now let us talk about their performance. For the 3 months ending the 31st of December 2025, Cantaloupe reported a net loss of $70,000. This is a small loss, but still a loss nonetheless. And for the 6-month period ending the same date, the net loss balloons to almost $1 million. This shows that the company is not currently profitable on a net income basis. But here is where the story gets more interesting. Total revenues for the 3 months ending the 31st of December 2025 reached $78.7 million, an increase from the previous year. And for the 6-month period, total revenues are over $159 million, up from the previous year. The growth in revenue is a positive sign, coming from both subscription and transaction fees, as well as equipment sales. For example, their equipment sales alone generated over $19 million in the first 6 months of 2025. But even as revenues grow, so do their costs. The cost to provide their subscription and transaction services increased by over $7 million for the 6-month period. This is like buying more ingredients to make more cakes, but the ingredients are getting more expensive. This is reflected in their gross profit for the 6-month period. Total gross profit saw a modest increase of about $2.6 million, reaching over $58 million. However, their total gross margin actually dipped slightly to 36.5%. This indicates that while they are selling more, their costs are increasing at a faster rate than their prices or efficiency. In terms of expenses, sales and marketing costs went up significantly, especially for the 6-month period by over $1.6 million. This suggests they are spending more to get the word out and attract customers. And then there are the big one-time costs. Merger, acquisition, and integration expenses skyrocketed to over $11 million for the 6-month period. This is largely due to the pending acquisition by 365 Retail Markets. These are significant costs incurred to get that deal done. Depreciation and amortization, which are non-cash expenses related to the wear and tear of assets and the amortization of intangible assets, also increased by nearly $2 million for the 6-month period, largely due to investments in internal use software. All these factors combined led to a substantial increase in total operating expenses, jumping by over $11.5 million to nearly $61 million for the 6-month period. Looking at other expenses, interest expenses decreased slightly, which is good news, but the overall picture shows a company that is investing heavily in growth and dealing with significant one-time costs. Now, Cantaloupe also provides some non-GAAP metrics to give a clearer picture of their core operations. Their adjusted gross profit for subscription services reached over $40 million for the 6-month period, showing strong underlying profitability in their recurring revenue streams. Their total adjusted gross profit for the same period was over $64 million. This adjusts for things like depreciation and amortization of acquired intangibles, giving a view of the business performance without those specific accounting items. And then there is adjusted EBITDA, a measure of operational profitability. For the 6 months ended the 31st of December 2025, their adjusted EBITDA was over $22.5 million. This is up from about $19.6 million in the prior year. This shows that on an operational level, excluding certain expenses, the business is generating more cash. However, when you look at the cash flow statement, things get a bit more nuanced. For the 6 months ending the 31st of December 2025, they actually generated over $10 million in cash from operating activities. That is a positive turnaround from the previous year when they used over $11 million. This suggests improvements in managing working capital and cash collections. On the investing front, they spent over $7 million on capital expenditures for the 6-month period, likely on new equipment and technology to drive future growth. In the prior year, they also spent nearly $10 million on the acquisition of SB Software, really showing their commitment to expanding through acquisition. Financing activities show a slight outflow of cash, but importantly, they had proceeds from the exercise of stock options, people buying shares, which is a good sign of employee engagement. Now, the elephant in the room is the pending acquisition by 365 retail markets. The deal was announced around June 2025, and they are still navigating regulatory approvals. They expect to close this deal in the first half of 2026. This acquisition will fundamentally change Cantaloupe. As it will no longer be a publicly traded company, it is a significant event, and the costs associated with it are clearly reflected in their financials. We also saw the acquisition of SB Software in September 2024. This acquisition was meant to boost their presence in Europe, and the financial impact is getting integrated. They are also dealing with contingent consideration, amounts that could be paid out based on future performance, which adds a layer of complexity. Looking at the overall picture, Cantaloupe is in a growth phase. They are expanding revenue, investing in their business, and making strategic acquisitions. The pending merger with 365 retail markets is a huge development that will reshape the company, while they are not yet consistently profitable on a net income basis. Their operational cash generation, as measured by adjusted EBITDA, is improving, and they have a healthy amount of cash on hand. The key challenge will be integrating SB Software effectively and navigating the complexities of the pending acquisition to ensure that the company's underlying business continues to thrive through these transitions. Alright, that is our breakdown of Cantaloupe's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.